I promise you, this video is going to open your eyes. You'll be able to see through all the lies that all these investment gurus are telling you. You will see through all the BS that the Dave Ramseys of this world are telling you. We all somewhat know that these stories of just depositing $100 every week and becoming a millionaire in a few years are not true, because we all know that money devalues to a degree. But how much really does it devalue? How did gold perform relative to monetary debasement? How did the S&P 500 perform relative to monetary debasement? How did gold perform relative to monetary debasement? How did the S&P 500 perform relative to monetary debasement? Heck, how did the GDP of the US perform relative to monetary debasement? Because on the face of it, charts like this look very, very pretty, right? A lot of people say the US has never been as wealthy as it is today. The GDP is constantly growing. But here's something else that's also growing. This is M2, the money supply. So really, what we should be looking at is how is GDP doing relative to the monetary expansion, relative to money printing. Have you ever seen anybody making that comparison? How did GDP actually grow relative to M2? Let me show you the very first eye-opener of this video, and it's not the last one. This is a chart starting in 1960, so 84 years of data. This is the US GDP divided by M2, and this went down minus 30%. If we measure the GDP relative to the monetary expansion, it actually did not grow whatsoever. All of the GDP growth and some can be attributed to money printing. And intuitively, we all feel this, right? In the early days, a single earner could easily feed a family of several children. And intuitively, we all feel this. In the 60s and 70s, a single household earner was able to carry a whole family of 3-4 kids. Nowadays, it's hard to just come by and earn enough money for your partner and yourself, even if both are working. And here's the worst about it all. This is GDP growth. And GDP growth doesn't happen equally, right? Most of the growth goes to the top earners and to the top investors. So if the GDP relative to M2 even shrunk, then for the average earner in the US, of course, the standard of living nowadays isn't as high as it used to be. Now the question is, what can we do with that information? What we can do is, again, try to escape this to a degree with investment. But how good do those investments actually work? Does the saving into the S&P 500 in the end save ourselves? Are we really getting richer over the long term despite all the volatility if we just get the average return, if we simply just invest into the S&P 500? Are we outpacing M2, or do we actually have to make an effort to outperform everyone else? Have a look at this chart. This is the S&P 500 divided by M2 starting in 1960. How much return did you make over 60 years if there was no monetary expansion? 16%. And considering the volatility, pretty much nothing. Now the S&P 500 is a price index, not a performance index. What that means is that on top of that performance, you also get the dividends, but you also get fees, you also get taxes. So in the end, are you really beating monetary expansion by just depositing into S&P 500 ETFs? Probably not. We all know about inflation. We all know that the same McDonald's burger today costs way more than 20 or 30 years ago. But how much more? And how much does investing protect us against this? It does protect us to a degree, but really just protect. You simply just keep pace with the monetary expansion with your investments. And in order to get ahead in life, in order to actually get a rising standard of living, you have to outpace the M2 growth. How much growth in income do you need every year in order to beat that nasty beast? Again, monetary expansion matters here, not the officially measured inflation rates. Because you want to spend on medical bills, you want to spend on tuition, you want to buy a house, and all of those things appreciate much faster. Their prices rise much faster than the officially measured inflation rate that just focuses mainly on consumer goods. And consumer goods long-term are deflationary, right? It's easier and easier to produce that bread. It's easier and easier to produce that TV. Technology does advance over time. So here we go. This is M2. This is the money supply. Let's look at this on a logarithmic scale. And yes, the growth does fluctuate somewhat, but let's simply just take take the beginning here all the way to today. We've got a growth of 7,184% and we've got 780 months. Now, how do we get the annualized growth rate here? First, we get the growth factor. So in this case, that's 72.84. Then we get the number of years. So that's 780 divided by 12. Now let's get the growth rate. So we're taking the growth factor and we take it to the power of 1 divided by the number of years. This is the annual growth factor, 6.8%. If your income is not growing by at least 6.8% every year, you are falling behind. Your stocks might appreciate long term with that rate, but if your salary doesn't catch up, it will get harder and harder to buy that house or to pay the tuition for your kids. The main problem with crypto YouTube is conflict of interest. Too many YouTubers shill garbage, promote garbage, and fill up their pockets in the background. Not this channel. Instead, there's simply the offer where I share my skills, my perspectives to you, and where I also share direct access to me, where you can ask me any questions. Feel free to check it out. The premium membership link is down below. And that effect, that growth rate in the monetary supply is the reason why Bitcoin was invented in the first place, right? We don't want to get our wealth stolen from us. And maybe, just maybe at some point in the future, salaries, compensation can actually be negotiated in Bitcoin, in something hard. Now, the argument is always that Bitcoin is volatile. But let's look at the S&P 500 relative to the monetary expansion. How volatile is that historically? Again, let's go back to exactly that chart. The S&P 500 divided by the monetary supply, by M2. Here we've got a drop of 73%. That was over the course of 20 years. Here we've got another drop, 72%, this time over the course of 9 years. Let's look at another potential hedge. This is gold divided by the monetary supply. Also pretty much zero return since the 1960s. Slight underperformance, 20%. But I mean, look at that volatility, right? This underperformance doesn't mean anything. How much can you underperform relative to monetary expansion temporarily? And we're talking here about more than 20 years. You can go down in purchasing power by 89%. So is Bitcoin really that volatile? Of course, it moves very quickly. It moves up and down very quickly. But we also see almost 90% drops relative to M2. Bitcoin did not drop that much. It dropped faster. It goes up faster. But it doesn't drop that much relative to M2. We simply have to zoom out to discover the truth. This is Bitcoin divided by M2. And yes, of course, this outperforms since Bitcoin adoption is growing. It's one of the few assets that's actually standing against monetary expansion. And let's look at those drops. A drop of 80%, another drop of 84%, here's another drop of 76%, and each time we recovered within 1 or 2 years. Is this Bitcoin chart really more risky compared to this gold chart, where again, the drop relative to M2 was larger and where the subsequent recovery took around 10 years and it hasn't even recovered fully since then? This is almost a philosophical question. What do you consider risk? Is this just price movements within a certain time frame, or is this actually how much an asset fundamentally can keep up with the money printing? Now here's the danger with all of this. A lot of people do not understand about these concepts. Some people do, right? Some people take on huge mortgages and they try to get financing rates below the monetary expansion, thus making a lot of money in the process because their debts debase over time. This is how many people in the US got rich. But the majority of people that are somewhat interested in investments, they simply just look at the US dollar valuation. They believe this crap of just investing $100 every week and becoming a millionaire soon. And they simply ignore how much is really purchasing power going down over time. Once it becomes more common knowledge that Bitcoin actually can effectively protect against all of this, a lot of power is taken away from the money printers. And maybe, and that's part of a conspiracy theory potentially, maybe that's why the people at the top fight so hard against a Bitcoin approval. Once Bitcoin becomes mainstream, the power goes to the people. It especially goes to the people if you self-custody your Bitcoin. Do not hold your Bitcoin in any third party's hands, because we have seen this in the past, right? The first inflation hedge, the first hedge against money printing was gold, and gold became illegal. In times of crisis, when leadership wants to double down on money printing, wants to double down on stealing wealth away from you, things that protect against that crime, assets that keep their purchasing power, they simply just get banned. But the nice thing about Bitcoin is that it's portable, and there will always be a pocket in this world that still allows trading Bitcoin. You can move your purchasing power across borders. There are some people that try to protect from all of this madness using tech stocks. And yes, the Nasdaq did outperform money print. This is the Nasdaq relative to M2, an outperformance of 1,375% over the course of 40 years. What we see here in the middle is the dot-com crash. The issue is that this does not come without at least short-term risk. This is the Nasdaq relative to the S&P 500. We are at levels comparable to the dot-com crisis, and we are not outperforming for 4 years roughly, even though there's way more risk in tech stocks. You might have seen the statistics, right? Most stocks underperform the index, and a lot of the alpha is concentrated in just a few tech companies. Why is that? Not necessarily because those tech companies are so genius, because they have monopolies. I think the main reason is that people are forced to take on more risk to escape that money printing. And so most people simply just invest in what is considered the safest of the growth stocks. And so most capital gets into the hands of very, very few companies. What are the main takeaways here? The first main takeaway is that you have to target at least 6 to 7% income growth every year. If you do not achieve this, you will fall behind, period. The second learning is that investing just in the S&P 500 is likely not going to cut it. You have to take on more risk, either by buying some growth stocks, but those are already very highly valued, or alternatively, and that's my main approach, using Bitcoin as a savings vehicle. There are ways to profit from all of this madness. For example, by devaluing debt. Unfortunately, right now, financing costs on property is very high. So alternatively, what one can do is buy long-term government bonds with the speculation that at some point the Fed will lower the interest rates again. So if you don't just want to hold Bitcoin and you want to be somewhat diversified, besides buying Nasdaq ETFs, you can also buy something like VGLT. So whenever interest rates are expected to go down again, this will go up, and this could potentially rise by another 40, maybe even up to 70%. If of course we hit the zero rates again in times of a financial crisis. If you're new here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. There's also a free Telegram. Link is down below.